fundamental question about inflation. How do we actually cure it? We'll explore 4 key terms: cost-push inflation, demand-pull inflation, disinflation, and reflation. Then, we'll focus on the process of reducing the money supply to bring inflation under control. This sets the stage for understanding how monetary policy works in practice. Let's talk about disinflation. It's the process of slowing down inflation, not stopping it completely, but bringing it under control. How do we do that? By reducing the money supply in the economy. When there's less money chasing goods and services, prices don't rise as fast. So, disinflation is really about managing inflation carefully to keep things stable without causing a sudden shock. Let's take a moment to think about the different types of economies based on land and labor availability. We have 4 categories here, from land surplus with labor scarcity to land scarcity with labor surplus. The question is, where does Indian agriculture fit in? Is it a land scarce, labor surplus economy, or something else? Understanding this helps us grasp the challenges and opportunities in the agricultural sector. It's a key piece in the puzzle of India's rural economy. India faces a unique challenge. There's not enough land to go around, but there's plenty of labor ready to work in agriculture. This means it's a land-scarce, labor-surplus economy. Understanding this helps us see why farming practices and policies need to focus on making the most of limited land, while effectively using the abundant workforce available. It's a key factor shaping the country's agricultural landscape. Let's take a moment to connect price theory with the broader branches of economics. Price theory is often another name for microeconomics, the study of how individuals and firms make decisions, and how prices coordinate those choices. It's different from macroeconomics, which looks at the economy as a whole. Public economics and development economics focus on specific areas, but price theory really lives within microeconomics. This question helps us anchor that understanding. Microeconomics focuses on the small scale, individual consumers, firms, and their decisions. It's where prices first take shape, based on supply and demand at this level. These price signals then ripple outward, influencing the broader economy. So, when we talk about microeconomics, we're really looking at the building blocks that eventually shape the big picture. Let's look at the different sectors that make up India's national income. We've got agriculture, industry, and services, plus a combined category of agriculture and industry. The question here is, which one contributes the highest percentage share? This is a key point because it shows us where the economy is most active and where growth is really happening. Understanding this helps us see the bigger picture of India's development. When we look at India's economy, the service sector stands out as the biggest revenue generator. It outpaces both agriculture, which is the primary sector, and industry, the secondary sector. This shift highlights how services like finance, and tourism are driving growth. So, when asked which sector leads in revenue, the clear answer is the tertiary or service sector. It's a sign of how India's economy is evolving and where opportunities are growing. Let's look at how agricultural products in India are graded and standardized. The question here asks which organization handles this important task. There are several key players: the Food Corporation of India, the Directorate of Marketing and Inspection, the Indian Standard Institution, and the Central Statistical Organization. Among these, one is primarily responsible for setting the standards and ensuring consistent quality across agricultural products. Understanding this helps us see how quality control supports the entire supply chain. Let's talk about the Directorate of Marketing and Inspection, or DMI. Established back in 1935, its main job is to standardize and grade agricultural products. Why? To protect farmers' interests. By ensuring consistent quality and clear standards, the DMI helps farmers get a fair deal in the marketplace. It's a crucial part of the system that supports agriculture from farm to market. Let's talk about a situation where there's too much money chasing too few goods. What do we call that? Is it deflation, inflation, recession, or stagflation? This question gets right to the heart of how money supply and demand affect prices. When demand outpaces supply like this, prices tend to rise. That's inflation. So the answer here points us toward understanding how economic forces push prices upward when goods become scarce. Inflation happens when people are willing to spend more money, but the amount of goods available doesn't keep up. In other words, demand outpaces supply, pushing prices higher. This slide highlights that key idea: inflation isn't just about prices rising randomly. It's about consumers competing for limited resources, which drives those prices up. Understanding this helps us see why inflation matters in everyday life. Let's look at what's behind the rapid growth of Indian exports. Is it the imposition of import duties? Or maybe liberalization of the economy? Could it be diversification of exports? Or perhaps a recession in other countries? Each of these factors plays a role, but one stands out as the key driver. Understanding this helps us see how policy and global conditions shape trade growth. Let's explore which factor really sparked this expansion. India's export growth has accelerated rapidly, and the main reason behind this surge is the diversification of the goods being exported. Instead of relying on just a few products, India has broadened its range, tapping into new markets and industries. This shift has opened up more opportunities and reduced dependence on any single sector, making the export economy stronger and more resilient. Diversification is the key driver behind this impressive expansion. Let's talk about what cheap money really means. It's often linked to a low rate of interest. That's the cost of borrowing being very affordable. But it also relates to a low level of savings, low income, and even a low standard of living. When money is cheap, it influences how people save, earn, and spend. This question invites us to think about all these factors together, not just one in isolation. Cheap money is a term we use when loans come with low interest rates. That means borrowing is cheaper and more accessible. It's a key concept in finance because it influences spending, investment, and overall economic activity. When money is cheap, businesses and individuals are more likely to take out loans, which can stimulate growth. So, simply put, cheap money means borrowing costs are low. Let's think about how saving habits differ between the rich and the poor. Do the poor save a larger part of their income, an equal part, a smaller part, or maybe even all of it? This question helps us explore the relationship between income levels and saving behavior, a key idea when we talk about financial stability and economic inequality. It's not always what you might expect. When income is low, saving becomes a real challenge. People with limited earnings usually can only set aside a small fraction of what they make. It's not about choice. It's about necessity. Their base income simply doesn't stretch far enough to allow for bigger savings. So, the portion they save tends to be much smaller compared to those with higher incomes. This reality shapes how financial strategies need to be designed for different income levels. Let's test our knowledge with a quick question. When was the Kisan credit card scheme introduced? Was it 1991, 1996, 1998, or 2000? Think about the timeline of agricultural reforms and credit initiatives. The KCC has played a key role in supporting farmers with timely credit. Keep that in mind as we move forward. Let's take a moment to look at the KCC scheme. It was introduced back in 1998. This wasn't just a random decision. It came from careful recommendations made by the R.V. Gupta Committee. Understanding this timeline helps us see how the scheme fits into broader policy developments. So, when we think about the KCC, remember 1998 is the key year to keep in mind. Now, let's focus on the organizations involved with the Kisan credit card scheme. The question here asks which organization prepared the report for this initiative. We have 4 options: the Ministry of Finance, SBI, NABARD, and RBI. Each plays a significant role in India's financial ecosystem, but only one is responsible for preparing this particular report. Understanding their roles helps us see how policies and programs like the Kisan credit card come to life. Let's talk about who laid the groundwork for the Kisan credit card scheme. It was NABARD, the National Bank for Agriculture and Rural Development. They prepared the initial scheme report, setting the foundation for what would become a vital financial tool for farmers. This initiative shows how targeted support can empower rural communities and boost agricultural productivity. Knowing the origin helps us appreciate the scheme's purpose and impact. Let's look at who the government of India takes ways and means advances from. This question lists 4 options: RBI, IDBI, SBI, and ICICI. The key here is understanding that ways and means advances are short-term loans to help the government manage its cash flow. The correct answer is the Reserve Bank of India, or RBI. They're the central bank and the lender of last resort for the government in these cases. Both the central and state governments sometimes need short-term funds to manage their cash flow. When that happens, they turn to the Reserve Bank of India for temporary loans called ways and means advances. These advances help bridge the gap between their expenditures and revenues, ensuring smooth financial operations without delay. It's a crucial mechanism that keeps the wheels of government running efficiently. Let's look at where NABARD plays its biggest role. NABARD is mainly linked with the development of agriculture and rural areas. While heavy industries, banking, and real estate are important sectors, NABARD's core focus is supporting farmers, rural livelihoods, and the agricultural economy. That's what sets it apart and defines its mission. So, when you think of NABARD, think agriculture and rural development first and foremost. The National Bank for Agriculture and Rural Development, as the name tells us, zeroes in on 2 key areas: agriculture and rural communities. Its mission is to support farmers and rural development, providing financial services tailored to their unique needs. This focus helps boost productivity and improve livelihoods where it matters most. So, when we think of this bank, we think of growth rooted deeply in the countryside. Let's look at a common banking term. When a customer is allowed to write checks for more than what's in their account, what do we call that? Is it a personal loan, an ordinary loan, discounting a bill of exchange, or an overdraft? The correct answer here is an overdraft. It's essentially permission to go beyond your balance, with the bank's agreement. This concept helps us understand how banks manage short-term credit for their customers. An overdraft facility lets current account holders with strong credit pull out money even when their balance hits 0 or isn't enough. It's like a safety net, giving access to extra funds when you need them most. This option helps manage short-term cash flow without the hassle of applying for a loan every time. In this case, the correct answer is an overdraft. Let's look at a question about taxes. It asks which of these taxes is not collected by the central government. We have income tax, custom duty, professional tax, and excise duty. 3 of these are central taxes, while 1 is collected by local or state authorities. This question helps us understand the division of tax responsibilities between different levels of government. It's a key point in grasping how public revenue is organized. Professional tax is a charge collected by state governments. It applies to individuals working in certain professions, like doctors, chartered accountants, and others. This tax is specific to these professions, making it different from other types of taxes. Understanding this helps us see how different layers of government raise revenue in targeted ways. In this case, professional tax is a clear example of that approach. Let's talk about the supply of agricultural products. It's usually categorized by how responsive it is to changes in price. On one end, we have perfectly inelastic supply, where quantity doesn't change at all, no matter the price. Then there's perfectly elastic, where even the smallest price change causes huge shifts in supply. Most agricultural products fall somewhere in between, often leaning toward inelastic or elastic, depending on factors like growing seasons and production capacity. Understanding this helps us grasp market behavior better. Agricultural supply is considered inelastic because the demand for these products doesn't shift much, even when prices go up or down. In other words, people still need their food, no matter the cost. So, supply remains relatively steady, since farmers can't easily adjust how much they produce in the short term. This is why the correct answer here is B, inelastic. It's a key concept when we think about how markets for essential goods behave. Let's take a moment to think about different types of economies. We have capitalist, socialist, mixed, and command economies. Now, the term laissez-faire is closely tied to one of these. It's all about minimal government interference, letting markets operate freely. Which one do you think that fits best? That's the question we're exploring here. Laissez-faire describes a market system where the government steps back and lets the economy run on its own. It's all about minimal intervention. Businesses and consumers make decisions freely. This approach is a hallmark of capitalist economies, where supply and demand shape the market without heavy regulation. So, when we talk about laissez-faire, we're really talking about capitalism in its purest form. Let's break down what happens to marginal product when total product rises at an increasing rate. When total product is climbing faster and faster, marginal product isn't just steady or falling, it's actually rising. This means each additional input adds more output than the last. So the answer here is rising. It's a key concept in understanding how productivity changes as we add more resources. When total product is increasing at an accelerated rate, it means each new input is producing more output than the one before. In other words, the marginal product, the extra output from each additional unit, is rising. This reflects growing efficiency, where every input adds more value than the last. So as long as total product speeds up, marginal product keeps climbing. The right answer here is B, rising. When we talk about small-scale industry in India, the definition hinges on a few key factors. Is it about sales by the unit? Or maybe the investment in machines and equipment? Could it be market coverage? Or perhaps export capacity? Each of these plays a role in understanding what qualifies as an SSI. This question helps us clarify which of these criteria actually form the basis of the official definition. It's important to get this right, as it shapes policy and support for these industries. When we talk about small-scale industries, the key factor is the level of investment in machinery. Specifically, these industries usually keep their investment below 1 crore. It's not about the size of the workforce or the output, but rather the amount spent on machines and equipment. This classification helps us understand the scale and scope of operations, and it's essential for policies and support tailored to these industries. So, the defining point here is the investment in machines and equipment. Let's talk about economies of scale. This concept is all about cost reduction as production or distribution grows. Specifically, it refers to lowering either the unit cost of production or distribution, or the total costs involved. When a company produces or distributes more, the average cost per unit usually drops. This slide asks us to identify which cost reduction economies of scale actually refers to, a key idea in understanding how businesses grow efficiently. Let's talk about economies of scale. This happens when producing more units actually lowers the cost for each individual item. In other words, as we scale up production, the unit cost goes down. It's a powerful concept because it means bigger operations can often be more efficient and competitive. Understanding this helps us see why companies aim to grow, to spread costs over more products and reduce expenses per unit. When we talk about free trade, what exactly do we mean? Is it just moving goods without any cost? Or is it about goods crossing borders without restrictions? Maybe it's about trading without duties or tariffs. Free trade really means the unrestricted exchange of goods and services between countries, removing barriers so markets can connect more freely. This idea is at the heart of many international agreements and shapes how economies grow together. Free trade means goods can move freely across borders without barriers or restrictions. It's about allowing products to flow from one country to another without tariffs or limits getting in the way. This openness encourages commerce, competition, and cooperation on a global scale. So, when we talk about free trade, we're really focusing on the free movement of goods between nations. Let's talk about different types of costs, focusing on one that's often tricky, the sunk cost. This is money that's already been spent and can't be recovered, no matter what you do next. It's important to recognize sunk costs because they shouldn't influence future decisions. Unlike variable or opportunity costs, sunk costs are behind you. Understanding this helps us make smarter choices going forward without being held back by past expenses. Let's talk about sunk costs. These are expenses that have already been spent, money that's gone and can't be recovered. Because they're in the past, they shouldn't influence our future decisions, even though it's tempting to think otherwise. This concept helps us avoid throwing good money after bad by recognizing when it's time to move on instead of holding onto what's already lost. Let's take a moment to focus on purchasing power parity, or PPP theory. The question here asks us which rate it's related to. Is it the interest rate, bank rate, wage rate, or exchange rate? PPP theory is all about comparing the value of currencies through their purchasing power, so the key connection is with the exchange rate. Understanding this helps us see how currencies adjust to reflect price differences across countries. Let's talk about purchasing power parity, or PPP theory. It's a way to compare different currencies by looking at what they can actually buy the same basket of goods, rather than just their face value. This helps us understand and equalize exchange rates, making sure we're comparing apples to apples when it comes to currency value across countries. So, when we hear about PPP, think about it as a tool for fair currency comparison. Let's take a moment to focus on different types of capital in economics. We have social capital, human capital, working capital, and overheads. Now, when we talk about knowledge, technical skill, and education, these are all part of human capital. This is the value people bring through their abilities and expertise, the foundation for innovation and productivity. Understanding this helps us see why investing in people is so crucial to economic growth. We all carry unique intellectual assets, skills, knowledge, and experience that set us apart. These aren't just personal qualities, they're what we call human capital. It's the value we bring to organizations and society, shaped by our education, creativity, and problem-solving abilities. Understanding this helps us see why investing in people is so crucial, because human capital drives innovation and growth in every field. When we think about what makes an entrepreneur truly essential, several roles come to mind. Is it supervision, keeping things on track day to day? Or management, organizing resources and people? Maybe marketing, getting the word out and attracting customers? Or risk-bearing, stepping into the unknown, taking chances others won't? Each function matters, but the heart of entrepreneurship often beats strongest in the willingness to bear risk. That's where innovation and opportunity meet. At the heart of entrepreneurship lies something crucial, the willingness to take on risk. Many roles and skills matter in business, but it's the ability to bear uncertainty and face potential loss that truly sets entrepreneurs apart. This readiness to step into the unknown, to bet on an idea despite the odds, is what drives innovation and economic growth. In this way, risk-bearing isn't just a function, it's the defining feature of entrepreneurship. Let's break down how money moves through the banking system. First, commercial banks receive deposits from the public. That's where it all begins. Then the central bank steps in, giving loans to these commercial banks when needed. Commercial banks, in turn, grant loans to their customers. Meanwhile, the government floats its own loans separately. Now, the key question, the bank rate, that's the interest rate at which the central bank lends to commercial banks. It's a crucial lever in monetary policy. Let's talk about the bank rate. It's the interest rate the Reserve Bank of India charges when it lends money to commercial banks. Think of it as the RBI's price tag for short-term loans to these banks. This rate influences how much banks pay to borrow funds, which then affects the wider economy. So, when the bank rate changes, it sends a signal to the entire financial system. In this case, the correct understanding is that the central bank lends money to commercial banks at this rate. Let's talk about goods that are scarce and limited in supply. What do we call these? They're not just expensive or luxury items. Instead, the right term is economic goods. These are goods that have value because they're limited. They're not available in unlimited amounts. Understanding this helps us see how scarcity drives value in the economy. So the answer here is economic goods. Economic goods are things that aren't unlimited. They have some scarcity compared to how much people want them. That scarcity is what gives them value. If something is easy to get, it usually doesn't count as an economic good. So when we talk about economic goods, we mean items or services that have value because they're limited in supply, but in demand. That's what sets them apart. When we look at economic development, there are several ways to measure it. GDP tells us the total value of goods and services produced. Disposable income shows what people actually have to spend. NNP accounts for depreciation, giving a slightly different picture. And per capita income breaks down income per person, which helps us understand living standards better. So, Which one gives us the clearest view of development? That's the question we're exploring here. When we want to understand how well individuals are doing economically, per capita income gives us a clearer picture. It breaks down the total income by the number of people, showing us the average income per person. This helps us see not just the size of the economy, but how that wealth is shared among individuals. So, when measuring personal economic growth or well-being, per capita income is the most precise tool we have. Let's talk about different types of currency, focusing on how they move across borders. The question here is about foreign currency that tends to move quickly from place to place. This kind of currency is called hot currency. It's known for its rapid migration, often chasing better returns or safer havens. Understanding this helps us see how money flows in the global market and why some currencies are more volatile than others. Hot currency is all about money on the move. These funds shift rapidly between financial markets, chasing the best interest rates available. The goal is to capitalize on favorable conditions before they change. In this case, the term hot currency perfectly captures this fast-paced flow of capital, making it the right choice for describing such dynamic financial behavior. Let's talk about disguised unemployment in India, where it's most commonly seen. The question breaks the economy into 4 sectors: agriculture, factory, service, and IT. Now, disguised unemployment happens when more people are working than actually needed, often without it showing up in official stats. This is especially common in the agriculture sector, where many people work on farms but productivity per worker is low. So, the agriculture sector is where disguised unemployment is most often observed in India. In agriculture, it's common to see more people working on a task than really needed. When that happens, some workers don't add extra value. Their marginal productivity is 0. This means they're not increasing output despite their effort. Understanding this helps us see why labor allocation matters, especially in the agriculture sector, where efficiency gains can have a big impact. Let's talk about the demand curve for a given good. Unlike typical goods, where demand falls as price rises, a given good behaves differently. Its demand curve actually slopes upward, meaning, as the price goes up, people buy more of it. This is quite unusual and goes against the usual downward falling demand curve we see with most products. So, when asked about the shape of the demand curve for a given good, the answer is that it's upward rising. Let's talk about given goods, a curious case in economics. These are inferior goods where, counterintuitively, demand actually rises as the price goes up. That means, instead of buying less when prices climb, people buy more. This unusual behavior creates an upward-sloping demand curve, which goes against the usual downward trend we expect. So when we see a given good, the demand curve isn't falling, it's rising. Here's a quick quiz for us. Who said that famous phrase, "Supply creates its own demand"? Was it Adam Smith, J.B. Say, David Ricardo, or Marshall? This question gets to the heart of economic theory, challenging us to recall which thinker first proposed this idea. Let's keep this in mind as we explore how supply and demand interact in the market. This slide highlights a key idea known as Say's law of markets. It's a fundamental principle in economics that reminds us how supply creates its own demand. The correct answer here is J.B. Say, the economist who first formulated this concept. Understanding Say's law helps us see the connection between production and consumption, a vital piece in the puzzle of how markets function. Engel's law explores how the quantity demanded of goods changes as a consumer's income shifts. It's about understanding the link between income and purchasing habits. This question asks us to identify which factor Engel's law specifically relates to. Is it price, tastes, substitutes, or income? The answer focuses on how demand responds to changes in income, revealing patterns in consumer behavior. Engel's law tells us something interesting about how people spend their money as they earn more. When income goes up, the share spent on food actually goes down. Instead, people start spending more on luxuries, things that aren't essential, but add comfort or pleasure. This idea helps us understand how changes in income affect what and how much consumers buy. It's all about the relationship between quantity demanded and the consumer's income. Let's look at a question about India's balance of payments. Specifically, what's included in the current account? The options are transfer payments, investment income, non-monetary gold movement, and short-term commercial borrowing. One of these does not belong in the current account. Understanding this helps us grasp how money flows in and out of a country and what counts as trade or income versus financial transactions. Let's explore which item stands apart. When we talk about the balance of payments current account, we're looking at financial transactions, expenditures, and revenues between countries. But it's important to note what's left out, specifically, non-monetary gold movements. These don't count in the current account because they're considered outside the scope of typical financial flows. So, when we analyze the current account, we focus strictly on money moving in and out, not gold that's just changing hands. Let's talk about the capital output ratio. What exactly does it measure? Is it the per unit cost of production, or maybe the amount of capital invested per unit of output? Could it be the ratio of depreciation to output, or perhaps working capital employed? The capital output ratio actually tells us how much capital is needed to produce 1 unit of output. It's a key efficiency metric in understanding investment and productivity. This ratio tells us how much capital is needed to produce just 1 unit of output. In other words, it measures the amount of investment tied to each unit we create. Understanding this helps us see how efficiently resources are being used and guides decisions on where to allocate funds for the best return. It's a key metric for evaluating productivity and capital intensity in any operation. When we talk about national income, we're really looking at the total value of goods and services produced by a country. But how do we measure that? Is it by weight, volume, money, or time? The answer is money, because national income sums up everything in terms of their market value. This lets us compare and understand economic activity in a way that physical measures like weight or volume just can't capture. Money gives us a common language for value. When we talk about national income accounting, there's a key rule to keep in mind. Only goods and services that can be measured in money are included. That means everything has to have a clear monetary value, no exceptions. This makes sense because money is the common language that allows us to add up the value of diverse things and get a meaningful total. So, the answer here is money. Let's take a closer look at what ECS means in banking transactions. The options here include electronic clearing service, exchange clearing standard, extra cash status, and excess credit supervisor. Among these, electronic clearing service is the one that relates directly to how payments are processed electronically between banks. It's a system that helps move money quickly and securely, making transactions smoother for everyone involved. This question tests our understanding of key banking terms and how they impact everyday financial operations. ECS stands for Electronic Clearing Service. It's a system that moves money electronically from one bank account to another. This method is fast, secure, and reduces the need for paper checks. When you hear ECS, think of it as the digital way banks settle payments between accounts. It's a key part of how funds flow smoothly in today's financial world. When we classify industries as agro-based or mineral-based, we look at 4 key factors. First, size, how big the industry is. Then ownership, who controls it. Next, raw material, the basic inputs the industry uses. And finally, output, what the industry produces. Among these, the classification mainly depends on the raw material they rely on. So, agro-based industries use agricultural products, while mineral-based industries depend on minerals. This distinction helps us understand their core operations and resource needs. Let's look at how the industry classifies its sources of raw materials. These categories help us understand exactly where the primary inputs come from, whether it's natural resources, recycled content, or synthetic alternatives. Knowing this is key to managing supply chains and sustainability efforts. In this case, the correct classification focuses on raw material sourcing, which forms the foundation for everything that follows in production. Let's look at a common question about international trade practices. It asks about selling goods in a foreign country at a price lower than what they sell for at home. The options are pumping, humping, dumping, and slumping. The key idea here is understanding which term describes this pricing strategy, one that can affect markets and competition across borders. It's a classic concept in global economics. Dumping happens when a company sells a product abroad for less than it charges at home. It's a strategy used in international trade to gain market share or push out competitors. While it might seem like a good deal for buyers, it can disrupt fair competition and lead to trade disputes. Understanding dumping helps us see the complexities behind global pricing and trade policies. Let's talk about bank deposits you can access anytime, without giving notice. These are called demand deposits. Unlike fixed deposits, which lock your money in for a set period, demand deposits let you withdraw funds whenever you need. Variable deposits can change terms, and account pay deposits are less common terms. So, when you want flexibility and instant access, demand deposits are the way to go. Demand deposits are the kind of accounts where you can access your money anytime, no advance notice needed. Think of savings accounts or the funds you can withdraw from an ATM. They're designed for immediate availability, giving you flexibility and control over your cash whenever you need it. This instant access is what sets demand deposits apart from other types of accounts. When a company needs new capital, it turns to a specific market to raise those funds. This slide asks us where new capital issues are placed. The options include the primary market, secondary market, gray market, and black market. The key here is understanding that new capital issues happen in the primary market. That's where securities are created and sold for the first time, directly from the issuer to investors. The other markets deal with trading existing securities. The primary market, sometimes called the new issue market, is where shares are created and sold for the very first time. This is the place where companies raise fresh capital by issuing brand new stocks directly to investors. It's different from markets where shares are traded between investors after that initial sale. Understanding this helps us see how companies get the funds they need to grow, right from the start. Let's look at the options for what prime cost might equal. We have fixed cost only, variable cost only, variable cost plus fixed cost, and variable cost plus administrative cost. The question is asking us to identify which combination correctly defines prime cost. It's a fundamental concept in cost accounting, helping us understand the direct expenses involved in production. Let's think about which costs are truly prime. Prime costs are the direct expenses a company faces when producing goods or services. These costs mainly include things like labor and raw materials, expenses that vary depending on how much you produce. So, prime costs are essentially variable costs. They go up and down with production levels, unlike fixed costs, which stay the same regardless of output. Understanding this helps us manage expenses more effectively. Let's talk about different types of taxes and how they relate to income levels. When the tax rate goes up as your income increases, that's what we call a progressive tax. It means higher earners pay a larger percentage of their income. This contrasts with proportional taxes, where everyone pays the same rate, lump sum taxes, which are fixed amounts, and regressive taxes, where lower incomes bear a heavier burden. Understanding these distinctions helps us see how tax systems impact fairness and equity. Let's talk about progressive tax systems. Here, the key idea is that as a person's income goes up, so does the amount of tax they pay. It's designed to be fair. Those who earn more contribute a higher percentage. This approach helps balance economic inequality, making sure the tax burden grows with the ability to pay. It's a fundamental concept in many modern tax policies. When we talk about capital formation in an economy, we're really asking what drives the buildup of assets and resources over time. Is it total income, total demand, total savings, or total production? Each plays a role, but understanding which one directly influences capital formation helps us see how economies grow and invest in their future. Let's explore how these factors connect and which one truly fuels the creation of capital. Capital doesn't just appear out of thin air. It's created when people and organizations decide to save money instead of spending it all. These savings then become the resources needed to build new capital, whether that's machinery, buildings, or technology. So, the total amount of savings in an economy directly influences how much capital can be formed or grown over time. Without savings, capital simply can't accumulate. When we talk about the industrial exit policy, we're asking about the options a business has when it decides to change course or even stop operations. Does it mean hiring foreign workers, closing down completely, shifting the products it makes, or moving to a new location? This policy defines the rights an industrial unit has to make those choices, especially when facing challenges or seeking new opportunities. Understanding this helps us see how industries adapt or exit in a structured way. This policy gives an industrial unit the option to step away from an industry entirely. It's about having the ability to either pause or fully shut down operations when needed. In other words, it's a formal way to close down, to exit the market completely, rather than just scaling back or adjusting. This kind of flexibility can be crucial for businesses facing major shifts or challenges. Let's look at a question about what shapes the supply of labor. We have 4 options here: the size and age structure of the population, the nature of work, marginal productivity of labor, and the work-leisure ratio. The key is to figure out which one doesn't actually influence how much labor is available. This helps us understand the factors that drive people's decisions to work or not. It's a subtle but important distinction in labor economics. When we talk about productivity, it's usually something we measure after someone's already been hired. It helps us understand how much value each worker adds on the job. But here, the key point, productivity doesn't actually set the starting amount of labor available in the market. That initial supply depends on other factors. So, the term that best fits this idea is the marginal productivity of labor, which focuses on output after hearing, not before. Let's consider what happens when the price of tea falls. How does that affect the demand for coffee? The options here give us clues. Demand could increase, remain the same, fall, or even become infinite. We're looking at how 2 products relate, whether they're substitutes or complements, and how a change in one price shifts demand for the other. This question tests our understanding of consumer choice and market dynamics. Let's look at how tea and coffee relate as substitutes. When the price of tea drops, people naturally buy more tea instead of coffee. This shift means fewer folks want coffee, so its demand falls. It's a simple swap. Cheaper tea pulls customers away from coffee, causing coffee's demand to go down. This example shows how changes in one product's price can directly impact the demand for another when they're perfect substitutes. Let's talk about how economics classifies goods, especially when it comes to things like seawater and fresh air. These are often called free goods because they're naturally abundant and don't have a price tag. They're different from normal goods, inferior goods, or the more unusual jiffin goods. So, when we ask how seawater and fresh air fit into economic categories, the answer is clear. They're free goods. We call these free goods because, quite simply, they're usually available without any cost. You don't have to pay for them, they're just there, ready to use. This idea helps us understand how some resources differ from others that require payment or effort to obtain. So when we talk about free goods, we mean things that are accessible to everyone without a price tag attached. Let's talk about the idea that consumers hold the key to what gets made and how much of it. This concept goes by a few names: consumer freedom, consumer sovereignty, market mechanism, and consumer power. Each term highlights a slightly different angle, but they all point to the same core truth. It's the choices we make as consumers that shape the market. Understanding this helps us see how demand drives supply in the economy. Consumer sovereignty is all about the power of choice. It means that what consumers want, their preferences and demands, directly shape what gets produced. In this system, producers respond to those desires, making products and services that match consumer needs. It's a way of putting the consumer in the driver's seat, guiding the market through their decisions. This idea helps us understand how markets stay responsive and dynamic. The law of diminishing returns is a key concept in economics, and here we're asked where it applies. Is it just agriculture? Or maybe only industry or mining? Actually, this law applies across all fields of production. Whether it's farming, manufacturing, or extracting resources, at some point, adding more input yields smaller and smaller increases in output. This idea helps us understand efficiency and limits in many areas of work and production. Modern economics teaches us something important. If we keep adding more and more input to a production process, at some point, the extra output we get starts to shrink. This idea applies across the board in every field of production. It's a reminder that more isn't always better, and efficiency depends on finding the right balance. Understanding this helps us make smarter decisions about how we use resources. Let's talk about inflation and its relationship with aggregate supply. Inflation happens when the total supply of goods and services in the economy is less than the total demand for them. In other words, when aggregate supply can't keep up with aggregate demand, prices start to rise. If supply matches demand exactly, prices stay stable. But if supply exceeds demand, inflation isn't triggered. So the key point here is that inflation occurs when aggregate supply is less than aggregate demand. When demand outpaces the available supply, prices start to climb, and that's what we call inflation. It happens because there's more chasing fewer goods. In other words, the quantity supplied is less than the total demand in the economy. This imbalance pushes prices up, affecting everything from groceries to gas. Understanding this relationship helps us see why inflation can spike when demand runs ahead of supply. Let's look at some common strategies linked to economic reforms and corporate restructuring. Voluntary retirement, inviting foreign companies, private investment in public sector units, and establishing joint enterprises all play distinct roles. Now, the Golden Handshake scheme is specifically connected to one of these. It's a way to encourage employees to leave voluntarily, often used during restructuring to reduce workforce smoothly. So, the key here is understanding which option matches that approach. This slide explains a specific term, the package or clause offered to employees who choose to retire voluntarily or during times when a company is restructuring. It's all about giving employees an option to leave on their own terms, often with some benefits or compensation. The correct answer here is voluntary retirement. It's a key concept when we talk about workforce changes and managing transitions smoothly. Let's consider how a reduction in the bank rate might influence credit availability. Will it make credit more expensive? Or will it actually increase how much credit is available? Maybe it won't have any effect at all. Or could it decrease availability? This question asks us to think about the relationship between central bank rates and lending, a key piece in understanding how monetary policy impacts the economy. When the bank rate goes down, borrowing costs for commercial banks drop too. That means banks can borrow money more cheaply. And because their costs are lower, they're able to lend more to businesses and individuals. So, the availability of credit increases, more loans, more spending, more investment. It's a key way central banks encourage economic activity when they want to stimulate growth. Let's take a moment to look at Gresham's law in economics. This principle deals with how different types of money circulate in an economy. It's often summarized as bad money drives out good. That means when two forms of currency are in use, the one perceived as less valuable tends to be spent more, while the more valuable one gets hoarded or disappears from circulation. So, the key idea here is about the circulation of currency, how money moves and behaves in the market. Gresham's law is a simple but powerful idea. It tells us that when two forms of money are in use, the bad money, usually the less valuable or debased kind, tends to push the good money out of circulation. In other words, people hold on to the better money and spend the worse. This concept helps us understand how currency moves and changes within an economy. It's all about the circulation of money. Let's talk about interest rate policy. Where does it fit? Is it part of fiscal policy, trade policy, monetary policy, or direct control? Interest rates are a key tool for managing the economy, but they're not about government spending or tariffs. Instead, they're closely tied to monetary policy, the way central banks influence money supply and credit conditions. So, when we ask which category interest rate policy belongs to, the answer is monetary policy. It's all about controlling the flow and cost of money. Monetary policy is the tool the Reserve Bank of India uses to keep the economy in balance. By adjusting interest rates, the RBI controls how much money is flowing through the system. Raise rates, and borrowing slows down, that cools inflation. Lower rates, and borrowing picks up, that can stimulate growth. It's a delicate dance, but this is how the RBI manages inflation and money supply to keep things steady. Let's look at what green GNP really emphasizes. Is it rapid industrialization, agricultural growth, sustainable development, or higher tax revenue? The key idea here is sustainability, balancing economic progress with environmental care. Green GNP measures growth, but with a focus on preserving natural resources and long-term well-being. So it's not just about how fast we grow, but how responsibly we do it. That's the heart of this concept. Green GNP looks beyond just economic output. It brings together sustainable development and environmental health with traditional measures of production. This approach ensures that growth doesn't come at the expense of our planet. In this context, agricultural growth plays a crucial role. It's a key driver of both economic progress and sustainability. So, when we talk about green GNP, we're really talking about balancing these important goals. Let's explore what happens when a currency is devalued. Typically, devaluation makes a country's exports cheaper and more competitive abroad. So, we often see increased exports, which can improve the balance of payments. On the other hand, imports become more expensive, which might reduce them. The key idea here is that devaluation tends to boost exports and improve the overall balance of payments, though the exact outcome can vary depending on other factors. When a country makes its own currency cheaper, it becomes more attractive for other nations to buy its exports. This boost in exports brings in more money from abroad, which helps improve the country's balance of payments. Simply put, cheaper currency encourages more sales overseas, leading to increased revenue and a healthier economic position. This is why we often see currency adjustments as a tool to support trade and strengthen financial stability. Value-added tax, or VAT, is a single tax designed to simplify the system by replacing several state taxes. These include income tax, surcharge and turnover tax, custom duty, and wealth tax. By consolidating these into one, VAT aims to streamline tax collection and reduce complexity. This slide asks us to identify which state taxes were replaced by VAT, helping us understand its role in modernizing taxation. VAT was created to make the tax system simpler. Instead of juggling multiple state-level surcharges and turnover taxes, it replaces them with one streamlined approach. This means fewer layers, less confusion, and a more consistent way to handle taxation across regions. So, when we talk about VAT, we're really talking about cutting through complexity by removing those older, overlapping taxes. Let's take a moment to clarify some key terms in international trade. The difference between visible exports and visible imports is what we call the balance of trade. It's a crucial measure, showing whether a country sells more goods abroad than it buys from other countries. This slide helps us understand how trade flows impact a nation's economy, setting the stage for deeper discussions about payments, terms, and gains from trade. Let's talk about the balance of trade, or BOT. This concept zeroes in on the exchange of physical goods between countries, what's exported and what's imported. It's a key part of understanding a nation's economic health because it shows whether a country is selling more goods abroad or buying more from others. When exports exceed imports, that's a trade surplus. When imports are higher, it's a trade deficit. This slide highlights that focus clearly. Let's think about what happens to real wages when the overall price level in the economy goes up. Real wages measure what workers can actually buy with their income, after adjusting for inflation. So, if prices increase but wages stay the same, the purchasing power falls. That means real wages decrease. In other words, even if your paycheck looks unchanged, it doesn't stretch as far. This question helps us understand the relationship between inflation and workers' true earnings. When prices go up, which we call inflation, the value of a fixed wage doesn't keep pace. Simply put, your money doesn't stretch as far as it used to. So even if your paycheck stays the same, what you can actually buy with it goes down. This means the real value of your wage decreases. It's worth less in terms of what it can buy. That's the key idea here. A firm reaches equilibrium when its marginal cost equals its marginal revenue. This means the cost of producing one more unit matches the revenue gained from selling it. At this point, total revenue is at its maximum, and total cost is minimized, balancing profit and efficiency. Understanding this balance helps us see how firms decide the optimal level of production to maximize their gains. Let's talk about equilibrium in economics. It's the point where the cost of making one more unit, that's marginal cost, exactly matches the revenue you get from selling that unit, or marginal revenue. When these two are equal, you've found the sweet spot for production. Producing any more or less would mean losing potential profit. This balance is key to making smart business decisions. Let's look at the organizations involved in collecting data for India's unorganized sector. The question asks which one specifically handles this task. We have 4 options: RBI, ASI, CSO, and NSSO. Each plays a different role in data and statistics, but only one focuses on the unorganized sector. Understanding their functions helps us see how data shapes policy and planning in India's diverse economy. The National Sample Survey Organization, or NSSO, plays a crucial role in gathering data about households and the unorganized sector. This data helps us understand the economic and social conditions that often go unnoticed. By focusing on these areas, the NSSO provides insights that inform policy and planning, making sure no part of society is left out of the picture. When we talk about scheduled banks in India, one key question comes up: which authority must they be registered with? The options include SEBI, RBI, the Finance Ministry, and SBI. The correct answer is the Reserve Bank of India, or RBI. This is because the RBI regulates and supervises all scheduled banks, ensuring stability and compliance within the banking system. So, scheduled banks must be registered with the RBI to operate legally in India. Scheduled banks are those that appear in the second schedule of the Reserve Bank of India Act. This designation means they meet certain criteria set by the RBI and are eligible for specific privileges and support. When we talk about scheduled banks, we're referring to institutions recognized officially by the RBI, which plays a key role in regulating and supervising their operations. This classification helps maintain stability in the banking system. Let's look at some common financial instruments: life insurance policies, long-term government bonds, national saving certificates, and provident funds. Now, the question is, which of these is not considered part of the national debt? We know that national debt typically includes government-issued securities and bonds. So, which one stands apart from that definition? This question helps us understand what really counts as government borrowing versus personal or private financial products. Life insurance is a private agreement between individuals, not a public debt. It often comes with tax advantages, making it a unique financial tool. Unlike government obligations, life insurance policies focus on personal protection and wealth transfer. Understanding this distinction helps us see why life insurance plays a special role in financial planning. It's about securing your family's future, not about owing money to the nation. Let's talk about a country's balance of trade. When is it considered unfavorable? The balance of trade compares exports and imports. If exports exceed imports, that's usually positive. If imports exceed exports, the balance is unfavorable. When exports and imports are equal, the trade is balanced. So, an unfavorable balance happens when a country imports more than it exports, meaning money flows out faster than it comes in. This can affect the economy in significant ways. When a country has an unfavorable balance, it means it's spending more on imports than it's earning from exports. In other words, the value of what's coming in, those imported goods, is higher than the value of what's going out. This situation can affect the economy in several ways, often signaling a trade deficit. So, the key takeaway here is that imports exceed exports, which can have important implications for the country's financial health. Let's break down the key terms that describe how a country tracks its financial interactions with the world. The balance of trade focuses on exports and imports of goods. The balance of monetary receipts looks at all money coming in and out. The balance of payments is a broader record, covering every transaction with other countries. And the balance sheet shows a snapshot of assets and liabilities. So, when we ask about the annual record of all monetary transactions with the rest of the world, which one fits best? Let's talk about the balance of payments, or BOP. This is the full record of every financial transaction between a country and the rest of the world. It tracks money flowing in and out, from trade, investments, and other financial exchanges. Understanding the BOP helps us see a country's economic relationships on a global scale, how it earns, spends, and invests beyond its borders. It's a key indicator of economic health and international standing. Let's look at a question about tax theory. Who suggested a tax on expenditure? We have 4 names to consider: Dalton, Kaldor, Musgrave, and Gautam Mathur. Each of these economists contributed important ideas, but only one is closely associated with the concept of taxing expenditure directly. This question challenges us to connect the right thinker to this specific tax approach. Keep these names in mind as we explore their theories further. Nicholas Kaldor proposed a shift in how we think about taxation. Instead of focusing solely on what people earn, he suggested taxing individuals based on what they actually spend. This idea challenges traditional income tax models and aims to capture a fuller picture of economic activity. It's a perspective that encourages us to rethink fairness and efficiency in tax policy. Let's take a moment to think about Dalal Street. It's a name many associate with finance and the stock market in India. Now, where exactly is it located? The options are New York, Delhi, Pune, and Mumbai. If you're familiar with India's financial hubs, you'll know this is a key question. Dalal Street is famously in Mumbai, the heart of India's financial district. It's where the Bombay Stock Exchange is based, making it a central spot for investors and traders alike. Let's talk about Mumbai, a bustling city known as the financial heartbeat of India. The word Dalal means broker in Marathi, which fits perfectly since Mumbai is home to the Bombay Stock Exchange. It's where countless trades happen every day, shaping economies and futures. So when you hear Dalal, think of the brokers at the heart of Mumbai's vibrant market. Let's talk about product differentiation. That's when products are similar but not identical, and businesses try to stand out. This feature is a key part of monopolistic competition. Unlike perfect competition, where products are identical, here companies compete by making their products unique. It's not a monopoly, where there's only one seller, and it's not a monopsony, which focuses on a single buyer. So, product differentiation really defines monopolistic competition. In monopolistic competition, we have many sellers offering products that are similar, but each one is branded or slightly different. Think about toothpaste, lots of options, but each brand tries to stand out with its own flavor or packaging. This setup means no single seller controls the market, but they still compete by making their product unique. That's the key idea behind monopolistic competition. Let's look at a quick quiz on market indices. We're asked which index the Nifty is associated with. The options include the Cloth Market Price Index, the Consumer Price Index, the BSE Index, and the NSE Index. Think about what Nifty represents. It's a benchmark for the National Stock Exchange. So the answer points us toward the NSE Index. This question helps us connect key financial terms with their real-world counterparts. The Nifty 50 is a key index that tracks the top 50 companies listed on the National Stock Exchange, or NSE. It's a benchmark that reflects the overall health and performance of the Indian stock market. When we talk about the Nifty 50, we're really referring to this specific NSE index, a snapshot of the biggest players shaping the market's direction. Let's talk about the break-even point, a key concept in understanding business performance. It's the moment where total revenue matches total cost. In other words, the business isn't making a loss, but it's not making a profit yet either. This is different from concepts like marginal revenue equaling marginal cost, which relates to profit maximization. So the break-even point is all about covering costs exactly, no more, no less. This slide shows the point where a business neither makes a profit nor suffers a loss. It's the moment when total revenue exactly matches total cost. In other words, all the money coming in covers every expense, but there's nothing left over. This is often called the break-even point, a crucial milestone for any venture to understand before aiming for profit. Here, the correct answer is total revenue equals total cost. Let's talk about a share broker who sells shares expecting prices to fall soon. This is known as taking a bearish position. So the correct answer here is a bear. A bear expects the market to go down, and they act accordingly. On the other hand, a bull expects prices to rise. The stag and bison aren't terms used for market expectations. So when someone sells shares anticipating a drop, they're acting like a bear. When it comes to market sentiment, we often hear about bears and bulls. Bears are the ones looking down, expecting prices to fall. Bulls, on the other hand, look up. They're optimistic, expecting prices to rise. So, if you're guessing which way the bear is looking, it's definitely downward, anticipating a drop. This simple imagery helps us quickly understand how traders feel about the market's direction. Let's talk about the money market. What exactly is it? It's a market primarily for short-term funds, where businesses and governments borrow and lend cash for brief periods. It's not about long-term investments or shares. Instead, it deals with negotiable instruments like treasury bills and commercial paper. So when we ask, money market is a market for? The best answer is short-term funds, quick, liquid, and essential for day-to-day finance. The money market is where highly liquid, short-term debt instruments are traded. These are financial tools that mature in a year or less, making them ideal for managing short-term funds. This market provides quick access to cash, helping businesses and governments meet immediate financial needs without locking money away for too long. In essence, it's all about short-term funds moving efficiently. Let's look at different types of taxes and how they affect prices. Import duty, income tax, octroi, and sales tax all impact the economy differently. But only one of these taxes doesn't directly cause the price of a commodity to go up. Understanding which tax that is helps us see how costs get passed on to consumers and which taxes stay behind the scenes. Let's explore this question and find the answer. Let's clarify how income tax works in relation to products. Income tax is charged on what individuals earn personally, their wages, salaries, or other income. It doesn't get tacked onto the cost of making a product, nor does it affect the product's price directly. So, when we think about taxes included in production costs, income tax isn't part of that equation. This distinction helps us understand where different taxes apply in the economy. Let's talk about legal tender money. What exactly does that term refer to? On this slide, we see different types of financial instruments: checks, drafts, bills of exchange, and currency notes. Among these, legal tender specifically means the money that must be accepted if offered in payment of a debt. It's the official currency recognized by law for settling transactions. So, when we ask about legal tender money, we're really asking which of these forms is universally accepted as payment by law. Currency notes are what the law recognizes as the official way to settle debts. When you owe money, paying with currency notes is the accepted method. It's backed by legal authority. This means currency notes aren't just paper. They're a trusted, standardized form of payment that everyone agrees on. In this context, the correct answer is clear. Currency notes are the recognized medium for settling debts. Let's talk about what a seller's market really means. It's a situation where demand exceeds supply. More buyers want the product than there are goods available. This creates competition among buyers, often driving prices up. It's the opposite of when supply exceeds demand, which tends to lower prices. Understanding this balance helps us see why markets behave the way they do, especially when commodities are involved. When there's a shortage of goods, it means demand is higher than supply. In this situation, the seller holds the power. They can set prices because buyers want the product more than it's available. This imbalance shifts control to the seller, who can dictate terms. Understanding this dynamic helps us see how markets respond when products are scarce, and why prices rise when demand outpaces supply. When we talk about dear money, we're referring to the cost of borrowing, specifically the interest rate attached to it. So what kind of interest rate does dear money describe? Is it a zero rate, fixed, high, or low? The term usually points to money that's expensive to borrow, meaning a high rate of interest. It's money that comes with a heavier cost, making it less accessible and more cautious to use. Let's talk about dear money. It's the opposite of cheap money. This happens when borrowing costs are high. In other words, the interest rates you pay to borrow are steep. When money is dear, it's more expensive to access funds, which can slow down spending and investment. So the key takeaway here is that dear money means a high rate of interest, making borrowing less attractive. Let's talk about the concept of the lender of the last resort in India. This term refers to the institution that steps in to provide emergency funding when all else fails, when banks or financial institutions face a liquidity crunch. Among the options here, the Reserve Bank of India, or RBI, holds this crucial role. It acts as the ultimate backstop, ensuring stability in the financial system during times of crisis. Sometimes, both the government and commercial banks run out of other options to borrow money. That's when the Reserve Bank of India steps in. It provides liquidity, essentially. It lends cash to keep things running smoothly. This role is crucial because it prevents financial systems from seizing up when usual lending channels dry out. So, when all else fails, the RBI acts as the lender of last resort. Let's break down the repo rate question. The repo rate is the interest rate at which commercial banks borrow money from the Reserve Bank of India, or RBI, against government securities. It's a key tool used by the RBI to control liquidity and inflation. So, among the options, the correct one is that commercial banks borrow from the RBI against government securities. This rate directly influences lending rates across the economy. Let's clarify the difference here. Unlike the bank rate, the repo rate is all about borrowing money by pledging government securities as collateral. In other words, commercial banks borrow funds from the Reserve Bank of India, using these securities as a guarantee. This mechanism helps manage liquidity in the banking system, making the repo rate a key tool for monetary policy. So, when you hear repo rate, think of borrowing against government-backed assets. Let's talk about what defines a closed economy. It's an economy that doesn't engage in trade with other countries. That means no imports, no exports, just internal production and consumption. It's not about being a member of the UN, having a coastline, or even international transport. The key factor is the absence of trade across borders. So, when we say closed economy, we mean one that's completely self-contained, economically speaking. A closed economy is one that's completely self-sufficient. It doesn't trade with other countries, no imports, no exports. Everything it needs is produced internally. This concept helps us understand how economies interact, or sometimes don't, with the rest of the world. When we say a closed economy, we mean no international trade at all. That's the key takeaway here. Let's break down the difference between GNP and NNP. It comes down to capital depreciation. That's the wear and tear on assets over time. So, when we subtract depreciation from gross national product, we get net national product. The other options, consumer expenditure, direct tax revenue, indirect tax revenue, don't factor into this calculation. It's all about accounting for how much value is lost as capital goods age or get used up. When we move from a gross figure to a net figure, we're accounting for the loss in value of our capital assets. This loss is called depreciation. It's the wear and tear that happens over time. So, to find the net amount, we subtract this depreciation from the gross total. In other words, the correct adjustment here is capital depreciation. It's a crucial step to understand the true value after accounting for asset use. Let's talk about the basic building blocks of business resources. When we mention raw materials, components, and finished goods, we're referring to the physical items a company uses or sells. These are collectively known as inventory. Understanding inventory is key. It's what a business holds to keep operations running and meet customer demand. So when you hear those terms, think inventory, the essential stock that keeps the business moving. Inventory is basically the stock a business keeps on hand, goods and materials that haven't been sold yet. It's what you have ready to meet customer demand, but that's still waiting to move out the door. Managing inventory well means balancing enough supply without overstocking, a key part of running a smooth operation. Here, the correct answer points us straight to inventory as that crucial concept. Let's talk about special drawing rights, or SDRs. They're often called different names, and this question asks us to identify which one fits best. Is it virtual gold, paper gold, plastic money, or silver gold? Each option hints at a different way to think about money or value. Understanding SDRs means knowing how they function in the global financial system and why they're sometimes compared to gold, but not exactly the same. Special drawing rights, or SDRs, are a kind of international reserve asset created by the International Monetary Fund. They're often nicknamed paper gold because, like gold, they hold high liquidity, meaning they can be easily used or exchanged among member countries. This makes SDRs a valuable tool for stabilizing economies and supporting global financial cooperation. So, when you hear paper gold, think of SDRs as a flexible, trusted resource in the world of international finance. Let's talk about what happens to total utility when marginal utility hits zero. Marginal utility measures the extra satisfaction we get from one more unit of something. When it drops to zero, it means adding more doesn't increase our total happiness at all. So, total utility reaches its maximum point. It stops growing, but it hasn't started to fall yet. This is a key concept in understanding how we make choices about consumption. When you reach complete satisfaction, that point where your marginal utility hits zero, eating or consuming more won't make you any happier. Your total utility has reached its highest level. This means you're at maximum satisfaction. Any extra consumption beyond this won't add to your happiness because you've already gotten as much benefit as possible. So the total utility curve peaks right here. Let's talk about where the law of diminishing returns applies. This idea shows up across different fields: agriculture, industry, mining, and all kinds of production. It's about how adding more of one input eventually leads to smaller gains. So, whether you're farming, running a factory, or extracting resources, this law helps explain why you can't just keep increasing effort and expect the same boost every time. It's a fundamental concept in understanding efficiency and productivity. This slide introduces a fundamental law in production. It tells us that when we keep increasing one input, like labor or materials, the boost in output starts to shrink. In other words, adding more doesn't always mean getting more, at least not at the same rate. This principle applies across all fields of production, no matter the industry or context. It's a universal truth that shapes how we think about efficiency and growth. When we see the term USB in marketing, it stands for unique selling proposition. This is the special factor or benefit that makes a product or service stand out from the competition. It's what convinces customers to choose one brand over another. Understanding the USB helps us focus on what truly sets us apart and why people should care. It's a cornerstone of effective marketing strategy. A USB stands for unique selling proposition. It's the one thing that sets a product apart from all the others, the specific feature that makes it different and better. It's what grabs attention, what convinces customers to choose one product over another. Understanding your USB is key to standing out in a crowded market. It's not just a claim, it's the reason people pick you. Structural unemployment can stem from several deep-rooted issues. It might be caused by deflationary conditions, when prices fall and demand drops, or a shortage of raw materials, which slows production. Sometimes, it's a mismatch between the skills workers have and what the market needs. And often, heavy industry bias limits growth in newer sectors. All these factors can create lasting gaps between jobs available and people ready to fill them. Structural unemployment happens when the skills workers don't match the skills employers need. It's not about a lack of jobs overall, it's about a gap between supply and demand in the labor market. Think of it as a mismatch, where workers' abilities don't line up with what companies require. This kind of unemployment can be tougher to fix, because it often means retraining or shifting industries. It's a challenge we need to understand to create better workforce policies. Let's take a moment to think about the relationship between unemployment and inflation. Which curve captures this inverse connection? We have the supply curve, the indifference curve, the IS curve, and the Phillips curve. The key here is understanding that as unemployment falls, inflation tends to rise, and vice versa. This classic trade-off is what the Phillips curve illustrates. So the answer to this question is the Phillips curve. The Phillips curve shows us an important relationship in economics. When unemployment is low, inflation usually runs high. And when unemployment goes up, inflation tends to cool down. This trade-off helps policymakers understand the balance between jobs and prices. It's a key concept that explains why managing the economy is often about finding the right middle ground. In this case, the correct answer is the Phillips curve. Let's take a moment to consider a key turning point in India's population history. The question asks, which year marks the Great Divide for the Indian population? The options range from 1904 to 1951. This isn't just a date, it's about understanding when significant demographic changes began to shape the country's future. Think about the social and economic shifts around those times. Which year do you think stands out as the pivotal moment? 1921 is called the Year of Great Divide because it marks a turning point in India's population growth. Before this year, growth was slower and more irregular. But starting in 1921, the population began to rise steadily and rapidly. This shift had major implications for the country's social and economic landscape, shaping the challenges and opportunities that followed. Understanding this moment helps us see how demographic changes influence history. Operation Blackboard is focused on improving education where it's needed most. It aims to provide primary education in underdeveloped areas, making sure children there get a chance to learn. It also works to open new schools for girls, addressing gender gaps. Another key goal is to supply essential teaching and learning materials so classrooms are better equipped. Finally, it reaches out to slum dwellers, ensuring education is accessible to all, no matter their background. Our main goal was simple, making sure schools had the basic tools and materials they needed to teach effectively. It wasn't about fancy equipment or extras. We focused on providing the minimum essential teaching and learning aids. These are the building blocks that help teachers do their job and students to learn. Without these basics, everything else falls apart. So, this initiative was all about getting those essentials right. Let's look at the accounting year of the Reserve Bank of India. The question gives us 4 options: April to March, July to June, January to December, and August to July. Understanding the accounting year is key for financial reporting and planning. The Reserve Bank of India follows one specific cycle, which sets the rhythm for its annual accounts and audits. Knowing this helps us grasp how the bank organizes its financial year. Here, we see a key difference in reporting periods. Commercial banks follow the April to March cycle, but the Reserve Bank of India, the RBI, uses a July to June year instead. This gives them extra time to gather and assess financial reports from all the other banks. It's a practical choice, ensuring they have the full picture before making decisions. So when asked, the correct answer is July to June. Let's look at who signs the 1 rupee note. It's a common question, but the answer might surprise you. Unlike other currency notes, the 1 rupee note doesn't carry the signature of the finance minister or the prime minister. Instead, it bears the signature of the finance secretary. This distinction is important because it reflects the unique authority behind this specific denomination. Keep this in mind, it's a small detail with a clear answer. Here's an interesting detail about the 1 note. Unlike other currency notes, it's issued by the Government of India, not the Reserve Bank. That's why you'll find it signed by the finance secretary, rather than the RBI governor. It's a small but important distinction that tells us who's officially responsible for this particular note. So, the correct answer here is the finance secretary. Let's take a moment to think about a famous slogan from India's history, Garibai Hatao, which means remove poverty. This slogan was launched during one of the 5-year plans, key periods of economic strategy. The question here asks us to identify exactly which plan introduced this powerful call to action. Was it the 1st, 3rd, 4th, or 7th plan? This helps us connect slogans to their historical context. This slogan was introduced during a very specific time in India's development, the 4th 5-year plan, which ran from 1969 to 1974. Indira Gandhi, who was the Prime Minister then, brought this slogan forward as part of that plan's vision. It captures the spirit and goals of that particular period, marking a significant moment in the country's economic and social strategy. Let's look at the question about the rupee 10 note. How many languages are actually used on it? The options range from just 1 language, all the way up to 17. It's a reminder of the rich linguistic diversity represented even on everyday currency. This question challenges us to think about how many voices and cultures are woven into something as common as a banknote. It's a small but powerful symbol of unity in diversity. We're looking at a total of 17 languages here. 15 of them appear on the language panel, and then we add Hindi and English to the mix. So, when we count them all up, the correct answer is 17. This gives us a clear picture of the linguistic diversity involved in the project or system we're discussing. Let's tackle a quick quiz question about currency notes. The special paper used to print them isn't just any paper, it's made at a specific place. The options are Hyderabad, Kolkata, Hoshangabad, and Duwas. Think about where this unique paper comes from. It's a detail that's easy to overlook, but it's crucial to the security and integrity of our currency. Let's focus on the location of the security paper mill for currency. It's an important detail, and the correct answer here is Hoshangabad. This site plays a crucial role in producing the special paper used for printing currency notes. Remembering this place helps us connect the dots between currency production and security measures in the financial system. So, Hoshangabad, that's the key location to keep in mind. Let's take a moment to explore a key term in economic history: the Hindu rate of growth. This phrase was coined to describe a period of slow economic growth in India. The question here is, who actually came up with this term? The options include Montek Singh Ahluwalia, Raj Krishna, K.S. Parekh, and A.K. Sen. Understanding who coined this term helps us connect with the economic debates of that era. Raj Krishna coined a term to capture the slow growth of the Indian economy, especially when compared to other Asian countries. This concept highlights the challenges India faced in keeping pace with its neighbors. Understanding his perspective helps us see why growth rates mattered so much, and why this term became a key part of economic discussions about India's development. Let's take a moment to think about the oldest stock exchange in India. We have 4 options here: Bombay, Ahmedabad, Bangalore, and Hyderabad. Each has its own history, but one stands out as the pioneer. The Bombay Stock Exchange, or BSE, holds the distinction of being the oldest. It's been a cornerstone of India's financial markets for well over a century, shaping the way trading happens across the country. Let's take a moment to appreciate the history behind the Bombay Stock Exchange, or BSE. Founded way back in 1875, it holds the distinction of being the oldest stock exchange in the country. This legacy gives it a unique place in the financial world, shaping markets and economies for nearly a century and a half. Understanding its roots helps us see how far the financial landscape has come. Let's talk about the term green gold. It's a phrase that's often used to describe something valuable and sustainable, usually linked to natural resources or crops. In this case, we have 4 options: rice, gold, coffee, and bamboo. The question is, which one does green gold actually refer to? Think about what's renewable, eco-friendly, and economically important. That's the key to unlocking this term. Bamboo is often called green gold, and for good reason. It grows fast, uses resources efficiently, and supports countless industries, from construction to textiles. This nickname highlights its value, not just economically, but environmentally too. Bamboo is a powerful example of sustainable growth that benefits people and the planet alike. Let's take a moment to consider a key figure in India's agricultural history, the father of the White Revolution. This revolution transformed milk production across the country, turning India into one of the largest producers of dairy products. Among the options, we have Baba Amt, J.P. Narayan, M.S. Swaminathan, and V. Kurian. Think about who led this remarkable chain and earned that title. Dr. Verghese Kurian is the driving force behind Operation Flood, a landmark initiative that transformed India's dairy industry. He's also the founder of Amul, the brand that became a household name. His vision didn't just change milk production, it empowered millions of farmers and reshaped an entire economy. Today, we recognize him as the architect of this remarkable success story. Let's take a moment to think about a key milestone in India's economic history. The question here asks, In which year was the very first 5-year plan launched in India? We're looking at 4 possible years: 1947, 1950, 1951, and 1955. This plan marked a major step in shaping the country's development strategy after independence. Keep these dates in mind as we explore the answer. We've reached the end by looking at India's first 5-year plan, which kicked off in 1951. This was a major step under Jawaharlal Nehru's leadership, setting the foundation for India's planned economic development. Remember, 1951 marks the beginning of this important journey. That wraps up our discussion. Thank you for joining.